Today, we're going to share with you in 3 simple steps how to evaluate any multifamily investment in 5 minutes or less. The problem is there's so many opportunities out there, and how do you have the cream rise to the top in a very quick way? Well, we manage over $100 million in real estate assets and have filtered through thousands of properties. So, what we're going to share with you today comes from a lot of experience. This simple framework we're going to show you will save you a lot of time moving forward. And we're super excited to go over this with you. John, great to be here with you.
Yeah, Mark, this is such a critical component for an investor because speed is king. In fact, one of our core values at Faris Capital is speed of execution. And that largely comes out of the fact that these deals don't sit around and wait for you. So when one comes through, you've got to act quickly. And for us, our goal would always be to like preempt the market, right? Maybe in other words, we get an offer out faster than the other players in the market. And so having that ability to filter down a deal in 5 minutes just to decide, should I spend more time on this or should I move on to some other opportunity is really going to be the formula for success. And so definitely excited to jump into this topic and dig a little bit deeper into these three key metrics that every investor should know.
Yeah, for sure. And so, John, it looks like we're beginning of 2025 and we're starting to see some deal flow starting to happen.
Yeah.
What are we seeing out there now?
A big shift from last year. So just in the past few weeks, so we're sitting here in the third week of January as we record this, and we've already received 82 deals from brokers across three key markets that we cover. So just in three markets, Tampa, Orlando, and Charleston, we've seen that flow. And so as you can imagine, our ability to filter through those quickly and decide which ones we're going to pursue versus which one get pushed aside, because as we've shared in previous podcasts, the hit ratio is about 1 in 200. And so it really is about finding that cream, that has risen to the top, and making sure that not only is it a good investment for our investors, but it's the right investment for our residents and Faris Capital partners. It's really critical to have these frameworks in place for quick decision making on where you spend your time. So once again, just excited to dive into this topic today. But deal flow strong. Still some challenges in the market, as you know, treasuries have risen. So current owner operators that have bad debt on their deals are suffering, but what that looks like is opportunities for buyers, and that's what we're seeing.
Yeah. And we're seeing a lot of investor capital just sitting on the sidelines, and we're getting phone calls now like, I'm ready for that next investment. And so for us, it's easy just to go ahead and take any deal, but we're just making sure that the deals that we go after, they're going to be a strong deal, strong results moving forward, because getting just like singles for us, we want to do a double, triple, and even like home run deals moving forward, because, these assets, they could be anywhere from 2 to 5 year business plans, right? So we want to make sure that we get it right the first time. And we're definitely seeing a bottoming of the market as well right now. So we're telling everyone, or friends or family, all the investors out there, that this is the time that you want to be in real estate. You don't want to be in real estate when everybody loves real estate. You want to be in real estate when it doesn't feel good to be in real estate. And we're definitely in that time right now. And the data that we're seeing out there is that a lot of the new development that had been built and started to be built when the market was peaking, those are all getting absorbed into the market now. So we're going to start seeing some rent increases within the next 12 months. And we're seeing a bottoming happening right now. So, John, this is definitely the time that investors really, I hate the word should, but I'm going to use it in this case, is like, you should, if you're thinking about an investment, real estate is the place. And multifamily, I'll call that the crown jewel of real estate when it comes down to investing.
Yeah, I mean, so, just pay attention to what's happening in our world right now. Demographics are shifting, populations are shrinking in future generation. And what that means is there's going to be less capital coming into the public markets. And in other words, if there's just fewer people for Apple to sell iPhones to, that means they're going to have some lost revenue as, the years progress. And so it goes back to why we love real estate. It's, something they're not making any more of. And, we've touched that on previous podcasts, but kind of going forward, as I look the next 5 and 10 years ahead, real estate is definitely top of mind for my investment dollars, just because I do think we're going to see. And by the way, our stock markets have been on an incredible run, and at some point we will hit a recession. And we've talked about how multifamily investment is one of the better hedges you can have against inflation. So just another reason why all investors should be considering diversifying by bringing more real estate into their portfolio. And so, yeah, yeah, it's an exciting time to be a buyer. But as you said, for us, these are 5-year holds. And, sometimes, we can execute in 2 to 3, but we have to assume maybe it's a 5-year hold. And one key lesson I've learned in business over the years is sometimes the best business you do is the business you don't take. That partnership you look at and you realize, oh, there's going to be some challenges here, and you don't get blinded by the revenue opportunity. You look at it and you say, you know what, there's going to be a cost here, in the cost benefit analysis, right? And so when we take down a deal, we need to know that we can execute our business plan with near perfection, and mitigate any of the risks that we may not see just from marketplace shifts, economic shifts, et cetera. And it goes back to housing being that core human need. So when we buy a deal, we need to know that we have the ability to execute our business plan once again with near perfection. And if we find a deal that supports those metrics and we know we have the ability to execute on, that's the only time we get excited. And hence why we have a 1 in 200 hit ratio, right? So it goes back to, you got to move quickly when you find a good deal. And so if you're wasting time chasing down a deal that, after, endless hours of underwriting and tours and visits, you come to find out it's just not the right deal, you might have missed that opportunity, right?
For sure.
Yeah.
Well, and it's interesting, out of all the things that Steve Jobs did, he did a lot of phenomenal things. He said that, he's more proud of the things that he didn't do than the things that he did do. And so you could imagine he said no many, many times. And actually that was the biggest thing when he came back to his company. He came in like acts, like it was like 95% of all the initiatives, and he focused in on the few that he knew were real winners. And so that's part of this. What we're going to be sharing with you is a framework to be able to, it's more going to be a snapshot at a very basic level, what a multifamily deal actually looks like. So the framework we're going to share with you is more, we'll say, how is it performing today? Not how is it going to be performing down the road. So it's going to be, we'll call it just a snapshot in time of how the asset is performing. And the cool thing is we'll give you a few simple ideas, or we'll call it frameworks, go, no go, some decision filter for you to be able to say, yes, this is an asset that I'm going to dig deeper in. And, the beauty of this is going to be a huge time saver for you moving forward as you have deals flowing through your desk, so to speak.
Yeah, I like to think of it's like the back of the envelope underwriting, right?
Yeah,
Just a quick
that's right.
snapshot. Is this something we should look at? Or is it, as we always say, no or no go, right? And this is that formula, that no go
Yeah.
exercise.
So there's 3 metrics there that are like absolute must that we look at when a property comes across our desk. And so the first one is cash flow. So basically, how much cash after your expenses and debt payment is the property making? We're going to be talking about that. And the reality is, Robert Kiyosaki said it well. Cash flow is king. And like we saw how important cash flow was in the market that we just went through. The assets that were maybe not carrying themselves, eventually you can only carry them so much if you're having to feed the deal. And so cash flow is the first one. The second is cash on cash returns, which is basically how much equity or money you put into the deal and how much you're actually getting in cash flow on a yearly basis. So that's cash on cash returns, or your return on investment. We're going to be talking about that. And then what the cap rate is. So we're going to be talking about cap rate, but essentially what that is at a high level, you take whatever the value is of the property or the purchase price, and you take how much the property is actually generating in net operating income, which is, so if you take $1 million property and the property is generating, say, $50,000, we'll call that after you have your income coming in, and then you have your expenses taken off of that, and you have your net operating income. This is before your debt payments. That's a cap rate. So in this case here, it'd be if it was $50,000 in net operating income on $1 million valuation of a property, then you're looking at a 5 cap. And we're going to be talking a little bit about that. So those are the 3 metrics that when we look at a property, we want to find out in a very quick way to be able to assess and compare to other properties to be able to say, is this a go or is this a no-go?
Yeah. And that cap rate, the way I like to think about it, that's almost like your comp comparison, right? That's how you compare your deal against other deals that are similar that have recently traded in the same marketplace. So in residential real estate, you just look at, homes nearby that are similar and see what they sold for. In
Mhm.
commercial, the cap rate is really that comparable metric that's so critical. And things, impact that, right? Your debt service, et cetera, whatever. So you have to kind of look at it in terms of some of that. So we'll dive into a sample deal here and help you understand this. And what we're going to do is really do a simple, straightforward, like 10-unit deal and get into these numbers and metrics so that you have the framework for this no go exercise.
Yeah, right on. All right, John. So first, we're going to actually just look at the property. And so, what are the main things that we actually need to be able to figure these metrics out? And so, this is where we got to look at first is, what's the overall income coming into the property? So that's like the gross rental income coming in. In this case here, we're looking at 10 units, right? So the 10 unit deal, there's $1,500 per unit per month, which works out to $15,000 per month total, which works out to 180,000. That is the gross rental income. So you take all the income that's coming in on the property, and so that's the first one. You need the gross rental income, right? Now, the thing is that that doesn't necessarily mean that's what you are collecting because there could be some vacancy. So we're going to look at this and say, okay, what's the vacancy in the last 12 months? And in this case, it was 5% vacancy. So we got to factor that in. And so that's where once you reduce that 5% vacancy, that's called your effective gross income. Okay. And so we're going to be going over what those numbers are. And then from there, we're looking at the operating expenses. Now, John, why don't you talk a little bit about if, say, the owner doesn't really know what their operating expenses are. Like I've actually bought buildings in the past where they, he handed me a handwritten page with the handwritten expenses for each item. And so there's no sort of data behind that. He was kind of winging it. But let's just say the owner doesn't actually have it handy. What are some percentages that a potential investor, when they're looking at multifamily, could use to be able to, do we'll call it a back of a napkin assessment?
Yeah, so we've seen that, right? And what's amazing is you would think it's only those mom and pop style owners that have the, handwritten financials, but you'd be surprised. Sometimes even with larger multifamily deals, we get very inconsistent or incomplete financials. It's not often, but it occurs. And so, historically, it used to be called the 35% rule. You could rely on that figure as just a quick back of the envelope estimate of what your expenses would be. But as everybody probably knows listening to this call, we've seen some larger expenses come through, right? Insurance being one of the main driving factors. And often we think about insurance in the coastal areas that are prone to things like hurricanes. But, across the United States and Canada, we have seen an increase in things like wildfires. And, in the US, we have the tornadoes. And so it's really an issue that's impacting all Americans. And obviously, these insurance companies, if one area is impacted, they raise rates sort of everywhere to help offset some of that, the cost for those owners in those, hurricane prone areas, as an example, say maybe in Florida. And so we're paying for that in Atlanta to an extent. So we use the 50% rule. It's just a more conservative approach and honestly more in line with where we're seeing expenses shake out. So that has presented challenges. You've got some deals out there that look really good, but you start digging in and you realize those expenses. So for us, we always assume at least 50%. And then when we get the real financials, if we decide this is a go deal, then we really drill down. And that's where you can start looking for opportunities to save. But taxes are rising, insurance costs are rising, and the materials costs are rising. Just the cost to get new lumber and new countertops and things like that. So, when you have a turn unit, right, you got to repaint it, you got to put new carpet in. Maybe the Formica countertops got damaged and you decide to upgrade to granite. So those expenses are critical, and we assume 50% just based on current market conditions.
Yeah, right on. So far we have the income, we have the expenses, and then the last deal assumption we need to look at is the mortgage and what does that look like. So in this case, the owner is telling you, okay, the asking price is say $1 million. Now we're looking at, okay, what amount will we be putting down in regards to equity? What's the down payment? Okay. And so we're going to take 25% is the down payment, which means that 75% we're going to get a mortgage. So we're also looking at the debt right now, and we're assuming that it's 6.5% is the interest rate we're going to get, and that's going to be amortized over a 25-year time frame. So we have income, expenses, and mortgage. These are the assumptions that we're going into this analysis moving forward.
And what's beautiful about this is as long as you know what the rents are, you can make an assumption around the expenses and then, call a lender or maybe even just download a simple mortgage calculator app and Google search and kind of look at current rates. And, once again, reminder, this is back of the envelope. So this is for that quick no, go or go analysis. And so, these data points, you don't have to do a lot of research. You just need to kind of know what the rents are, and then you can still come up with these numbers to decide whether this is a deal worth pursuing. So that's a key factor here.
Right on, John. So it looks like we have what we need in order to proceed. And so that's the step one, is to gather the property information. So you have your gross rental income, you have your effective gross income, and then you have your operating expenses, net operating income, and your annual debt service, which is your mortgage payment. Okay. And so that's the beauty of this. Now we have the data to be able to make this assessment moving forward here.
That's right. Yeah, it's going back to what we touched on, right? This is a 10-unit deal with $1 million sales price and $100,000 in gross rental income. So we start there at the top. So we've got our $180,000 income coming in on this property. Now, remember, we touched on that 5% vacancy rate. Now, some markets, that vacancy rate might be higher, but we look at the deal itself, the property itself. So in this case, we know it's got a 5% historical vacancy rate. So we have to remove some rent from that gross rental income, because realistically, things come up, people move out, you have unit turns, things like that. So, just more of a tidbit, just how we think when we see 100% occupancy, that actually signals that maybe the owner isn't pushing rents hard enough. So a little bit of vacancy is actually healthy, and it just shows that you're actually hitting those market incomes. So with that 5% vacancy, we have to remove $9,000 from that gross rental income, which gives us effective rental income of $171,000. So once we've got that number, now we need to look at that expense ratio we talked about, which is 50%. So 50%, that's $85,500, right? So we going from the top, just as a refresher: 180,000 gross rental income, 9,000 in vacancy that we have to account for, which is 171,000 in gross effective gross income, and $85,500 in expenses. When you look at all that, that brings us to a net operating income of $85,500.
Yeah. Yeah. No. And so this is what we need in order to calculate, which is step two, the multifamily metrics, which is cash flow, cash on cash return, and then the deal cap rate, which you could see here. We've actually come up with the cap rate. We've taken a step forward a little bit here, but this is all the data that you need in order to come up with the three most important metrics moving forward. So let's just look at step two there is to calculate these metrics. So first one is cash flow. So John, how do you figure out what cash flow is? So you're looking at this deal right now, you're seeing the numbers. What's the formula when it comes down to cash flow?
Yeah, so cash flow is pretty straightforward. It's your net operating income minus your mortgage payment, and that equals cash flow. So it's a really simple, straightforward formula, because when you're calculating cap rate, you're actually not taking into account debt, right? So this is really like what the deal actually is going to cash flow, right? Because mortgage is real, and if you're paying a 6.5% mortgage, which equals $60,288 annually, we have to remove that from that effective gross income. And that shows you what are we walking away from, or what do we have in our pockets on a monthly and yearly basis based on the performance of this deal. So in this context, we have that $85,500 income coming in, that net operating income, and then we reduce the $60,288 mortgage payment. So that creates $25,212 in annual income, or to say it another way, $2,100 in monthly income on this property. So cash flow is $25,000 in change a year.
Yeah. So far, this is looking like a very healthy deal, and we're going to get anything that is cash flow positive. We start to get interested in the property, but this one's looking good so far. So that's step one. The second is your cash on cash return. So the cash on cash return is basically you take what your annual cash flow is, how much money that you're making in a year, and you divide that by the down payment, the amount of equity that you put down in the property. Because your return is not on the value of the property. Your return should be on the amount of money that you outlay here. And so in this case here, you put down 25,000, or the amount of income that you're actually generating is the first number, $25,212, and you put 250,000. So that cash flow is divided by 250,000, and so that works out to a big whopping 10% cash on cash return. So that's really healthy, John, on this deal. Like we found a good one here.
Absolutely. For a multifamily deal, we would call that a screamer. So, one way to compare, right? So, is this good cash flow or is this not good cash flow? Kind of depends on the market. But one of the one things we like to look at are what could we get if we just simply put that money into a bank CD? And today, we're sitting here in early 2025. CD rates are anywhere between 4.5% to 5%, depending on how aggressive the bank is. Some banks are even offering lower than that, but on average, around 4.5%. So if you're more than that, then that signals that this is a go deal or one you should continue to consider as you do your underwriting analysis.
Yeah, right on. Now, I know on the previous slide here, for those that are watching on YouTube, if you're listening in on the show, we had a slide there. So check out YouTube if you get a chance, and you'll see a couple of them. But we did have the cap rate out there. But the cap rate essentially is your net operating income divided by that sales price or the value of the property. So in this case here, we were looking at 85,000. 85,500. That's your net operating income for the year. And you divide that by the $1 million sale price, or the asking price, we'll call it, at the time that we're assessing this. And that works out to 8.55% is the cap rate on this. So in that case there, John, like that's a really great cap rate as well. And we're seeing cap rates now at like 5.5. If we see a 6, we get pretty excited.
Yeah. Absolutely. And, generally those six caps have some hair on them, right? So it could be more opportunistic, or there could be something that happened at the property, down units or things that impacted. So that's a good thing to see, but it just does require, it's like a mental note to say, okay, we really need to dig into the financials to see why that might be, especially if comps in the area are showing cap rates more in that 5.5, 5.75 range. But it's a good thing. Now, sometimes too, you just find a great deal. You find an owner operator who is just ready to sell, not necessarily a fire sale, but just ready to get going. So an 8.5% cap rate on a multifamily deal is a strong cap rate, and one that would definitely signal to us it's time to really dig in here on this property and execute that speed of execution, as we like to say.
Yeah, for sure. And there's a lot of operators that would look at that and say, well, cap rate is a measure of risk. The higher the cap rate, the riskier the deal. That in general, that would be the case, but there's some deals there that the operator is just looking to unload it and it's performing really well. One thing I would recommend is that if you are going into an asset with a high cap rate, just really look at, is that in an area that you want to be in? Because, John, we've seen this before. Like, you're going into maybe an area with high crime, and the deal cap rate is actually really strong, and the cash on cash is really strong. But then you go to the P&L and you see, oh my goodness, like the amount of, we'll call it maintenance on the property, and the amount of turnover, is really high as well. And so this is something you got to be really careful of, because the reality is that it's going to be a lot more maintenance, and there is more risk in general when it comes down to higher cap rates.
Absolutely. So really, that just brings us to those go, no go standards, right? So to just sum it up very simply, cash flow needs to be positive. That's number one. Number two, your cash flow needs, or cash on cash return needs to be a minimum of 5% or more. And your cap rate should be greater than market cap rates on recent sales. Now, it doesn't need to be dramatically larger, but that just signals you're getting a good deal. But as you pointed out, cap rates get too high. That is generally a signal of greater risk in the deal. So it's something that would just be more of a note to when you're doing your full underwriting to really try to understand why that might be. And does that actually take a go deal into a no go deal as you do your further analysis?
Yeah, for sure. So it's really great, guys, to have a framework. And so you are now moving forward, you have a framework to be able to look at these deals and say, okay, this is a good deal or it's not a good deal. Just remember that this does not factor in potential upside in the property. So it's a snapshot in time. So one of the key things that we look at, in addition to these three measures of performance, is we love to see what is the potential lift in rents that we can actually go in and execute a business plan on. How much can we lower expenses to be able to drive net operating income higher? Because that's going to tell us what kind of upside the property has. So even though perhaps a cap rate could be lower, there could be a huge amount of upside by driving that operational excellence side of it. So that's just more of a side note to this, is that even though the snapshot might be saying it's not that strong of a performer, you got to look at behind the curtain as to where's the upside in the property, where we'll do another session on that as to how do you project out in regards to potential returns to drive higher returns for either your investors or for yourself investing.
That's right. Yeah, it goes back to frameworks are important. You have to have a decision-making process before you move forward with any important decision, whether in your business or in your investment portfolio. So these frameworks will help you make sure you're making an educated and smart decision on where you spend your time.
Right on. So just the three simple steps here, guys, for evaluating a multifamily property. One is to gather the property information, which we shared earlier. Number two is to analyze the key metrics of cash flow, cash on cash returns, and the deal cap rate. And then three is to have a decision framework that's consistent to be able to compare properties as they're coming across your desk on an ongoing basis. I hope you guys got a lot of value from today. Thanks for listening. If you enjoyed the show, please subscribe and share with other high net worth investors that you believe will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.